All right, welcome to another episode of Breakaway from the Rat Race. And today we have the pleasure of speaking with Randy Langenderfer. Randy is president of InvestArk Properties, focusing on creating investor value and passive income for the busy professional. He's been in multifamily in real estate since 2014 as both a general partner and a key principal in about 1,100 doors and in limited partnership position or roles in over 4,000 doors. So, Randy, welcome to the show.
Eric, thanks so much for having me. It's really a pleasure to be here and hopefully build into your audience.
Yeah, excellent. So I think that, what you're trying to do and who you're trying to help is really my audience, is the busy professional who are trying to get out of the rat race or plan for retirement. Eventually, we're all going to need some passive income and legacy for their children. So this is just perfect. So tell us more about your journey. When did you get started in multifamily and why?
Well, thanks. I got started in I'll say real estate in 10, 11 time period doing single family hard money flips in South Florida. At the time I was living in Cleveland, Ohio market. And I got a brother-in-law who got me involved as a hard money lender. And we had success. And I relocated to Houston. I'm currently residing in Houston, Texas, because I was working for, I'd achieved, in the corporate world and risen to a level and realized that I was working for a private equity company and those jobs just don't last.
Mm-hmm.
They're only good for 5, maybe 7 years. And so I relocated to Houston for a job and got real excited about continuing on the single family hard money, but got really busy with the move and family and attended a seminar about late 2013 about multifamily.
Yeah.
And I have just never turned back. It just really resonated with me because one, the concept of economies of scale, that, if I have one single family unit and it's empty, I got 100% vacancy. But if I got a large 100-unit multifamily complex and there's one vacancy, I got 1% vacancy. And that, and the fact that I learned, I can buy a multi-million-dollar apartment building easier than I can probably buy a $500,000 private home, because they're secured by the asset themselves and the revenue. Yes, you have to have liquidity and you have to show it to the bank, et cetera. But the point of it is you don't have to go through the W-2 testing and all that. So, and they're non-recourse loans for the most part. And that was another very intriguing part of me, because I had reached the age of life where I did not want to sign personally on something where they could come after my other assets.
Yeah.
And so non-recourse leverage, economies of scale, and then finally syndication. When I learned about syndication, and that is other people's money primarily, and it's just a very nice asset class, and I haven't found anything since then that I like as much that has tax advantages, positive cash flow, and appreciation. So
yeah,
short answer.
Yeah, so that's good. So you went to that webinar, and then so what was your first deal? What did your first deal look like? And did you jump right in there? And how,
So I remember going to one of these large educational groups in Dallas, and it's 400 or 500 of your nearest and dearest friends, and I was talking to people and say, how do I find these deals? I mean, how do I get in one of these things? And you just hang around and talk to people, and I did. And so the short answer is I got in my first deal in the spring of 2014 with a guy who I had met.
It took a while then, because you did the webinar, not the webinar, the conference.
Yeah, I did the class in late 13 sometimes. So it took me 5 to 6 months after that before I actually, your hands shaking as you write that first check for 50,000. Is this a Ponzi scheme, or is this anyhow?
Yeah.
But I invested with a guy that I had met, and basically, as we'd say, that I know, liked, and trusted. And we bought an asset in Port Arthur, Texas. And for your listening audience, that's about 150 miles due east of Houston, between us and Lake Charles in Louisiana. And it's a very blue collar town, a very I would advise you not to buy in Port Arthur, Texas today if I were advising you.
Oh, really? Wow.
Yeah, it's just a tough neighborhood and a whole lot of lessons learned, on that one. But so 8 months after the first introduction is when I wrote the first check for my first limited partner
Okay.
investment. So,
Yeah.
and I'm a finance accounting professional at heart, and so I'm fairly risk adverse.
Mm-hmm.
And I didn't even want to write a check for $50,000, so I found somebody to partner with, and we split the $50,000.
Okay.
As
Wow. Wow.
I always calling that leveraging or lowering my risk to de-risk because
And there's nothing wrong with that. I think, to both get involved, you spread the risk, you both learn about kind of like the experience and all of that. And then so you can do it again and learn on the second one also, instead of try to learn all at once and losing everything.
Exactly. And that one, you hit it on the head. That was the whole point. I had another friend that was wanting to get in and learn, and so we did it together. And I leveraged that sponsor or that general partner and asked a lot of questions and offered to do work for free, like due
Okay, yeah,
diligence and other things, just to learn the business.
yeah. That was my other question too, because some people, obviously, we're talking up to busy professionals, so they don't have time to be involved in the deal itself. And then they invest in these as limited partners in syndications, but then in the hope that, oh yeah, I'm going to learn how they do the business, how they structure the deal, how they do that. No, you're going to get like a report, like some balance sheet and income statement every quarter, and then they're going to tell you how the project is going. You're going to have some pictures, and then you're not going to learn how they've done it. You're going to learn by doing, right? So,
And it just depends on what your objective is.
yeah.
I knew all along that I wanted to do more and move into this full time gradually. And so, but there is, like you said, there's a ton of people that are just truly limited and don't want to do anything other than get a healthy return.
Mhm.
Period.
Yeah. Yeah.
And
Or they
maybe,
do,
like
but
you
then
said, read a
but they don't realize the amount of time that's needed or whatever, the
yeah.
commitment. So you got involved in that deal, and then you obviously it was in Texas, it was close by, and you said, okay, well, I want to learn, I want to ask you lots of questions if there's anything I can do to help. How many other limited partners were there on that deal?
I believe that first one, and don't quote me exactly, I can say about
Yeah.
25,
Oh,
28
okay.
different limited partners.
Yeah.
At the time, it was a fairly good deal, and so it was a fairly good size syndication.
Yeah. But I would guess that most of them didn't want to be involved. I think you were part of.
Oh, absolutely.
Yeah. Yeah.
Of those 27 or 28, I'm the only one that I knew of that took the
Yeah.
approach I did.
So how did that work for you? Like, did the GP actually said, okay, yeah, I'm gonna help you. You can help me with
Yeah.
this. I can show you this. He did.
But it worked, and then kind of the luster wore off for me, and I was trying to find the next deal, and he was on to his next deal as well. But I mean, it worked. I gained information,
Yeah.
a lot about the due diligence process, a lot about property management. I was real interested in property management.
Mm-hmm.
I mean, for your listening audience, that's one of the questions you should have on your passive checklist. If you don't, is kind of like the relationship with a property manager and what's their experience in that sub-market and what's their experience in that
Yeah.
asset class.
Yeah.
More so than we're hiring XYZ property management company.
Oh yeah, absolutely. Yeah, I mean we my book and stuff like that, and I talk about that, about kind of like how to select the right property manager. I mean, because they have like their big property management company, big firm and stuff like that, doesn't mean this is the one you should go after. You have to have some kind of alignment of interest. And I think alignment of size, they have to do the same kind of asset class that you're doing. Because this is a big company, they have lots of employees, doesn't mean it's gonna be a good relationship and a successful relationship.
And most likely, if it's a big company and you're a first timer, you're going to probably be taken advantage of, not intentionally, but you're not going to get the attention.
You're not going to get the value out of
Yeah.
it. Yeah, because you're going to be a small player, and then they're going to say, well,
unless you start buying more and adding to it,
yeah,
is the only way you're going to get some leverage with them.
Mm-hmm. So what was at that time? Were you like working full time and you had already exited your job?
No, so yes, I was still working full time. So I'm currently still working full time and doing
Okay.
this full time. I do have a fairly narrow exit plan in the next 5, 6 months to walk away from the corporate world and do this full time. But yeah, I was working full time and have for the last 9 years doing this
Okay.
and building my portfolio and working and all those things.
Okay. When you say working full time, you mean right now you're working full time on your portfolio?
Right now, I'm working full time for a large academic medical center in Baylor, in Houston, Texas. And I
Okay.
also work 3/4 on real estate.
Okay.
I'm ready to. I'm going to start. I'm going to shed my corporate job.
Okay. So you have a job.
I have a W-2.
Yeah.
A W-2.
Okay, so that's a good point. So let's talk about that, because at what point do you decide that, hey, this is how am I to say that, okay, I'm ready now to retire, or maybe I like my job and then I want to continue working, and maybe that's your situation. And then, but how do you plan for the exit? How do you make sure that your exit is prepared correctly? At what point, like what are the metrics that are going to say, okay, I'm ready?
That's a great question, and I think it's really a personal or an individualized response for every one of your listeners. I can really just tell you about my journey, which when I came to Houston, I had a 10-year plan, and that's now coming to a near end. But I realized that I needed to have a passive income stream. I really needed to have something else. My wife was a stay-at-home mother and still is, and so I was the primary breadwinner, and so I really needed to have a second income, something that was going to leverage off with. And I really wasn't interested. I hear a lot of people talking about, you should quit your W-2 job, and I really didn't want to, no disrespect, go down to a $50,000 a year job or something like that, because my standard of living is just higher than that, I'll say. So I kind of set up this long-term plan of investing passively, learning the business, understanding the team dynamics and all the resources that were needed, and moved into general partnerships. And now I'm growing those general partnerships, and those are really becoming to fruition, where they're providing an income stream for me that is sustainable.
Yeah.
And some people do that, just quit, and their spouse is working and maintaining benefits and got an income, and they go at it all in for really fast, really quick. Mine has always been more of a go slow, go steady approach, and make continuous progress. And so that's kind of my journey, but it's up to everybody. I don't know people who have got literally millions of dollars invested as passive income people, and that's fine.
Yeah.
And I know others that have really focused on growing the syndication business and growing the general partnerships, and they've got hundreds and thousands of doors as well. And so your listening audience has to kind of decide what they want that to look like for them.
Yeah.
And how much, what's the number, right? We always talk about what's the number to retire, or what's the number to quit your W-2 job.
Yeah, that's right. I mean, for me, like I talk to my audience and the people that I mentor and coach about their passive income target. What is their monthly passive income target that they need to reach? And then start building your passive income portfolio, until you're kind of like, you get close to that. You get to 80%, 90% of that. Then you have a choice to make. You can either jump in, and then as long as it makes sense that you can really accelerate your portfolio if you quit your job. So there are situations like that where, well, if I quit my job, I could easily increase that portfolio 50%, and I would be done. And then you have other situation where, no, I want to continue, I enjoy my job, and I want to continue to grow my portfolio slowly, and I have lots of time and all that kind of stuff. So it's really
it's really not a right or wrong answer.
No, that's right. I mean, it really depends. And some people, they just want a passive income. It covers kind of the ups and downs, and then eventually some people are really risk averse. As you know, you used to be a CPA, and I think that's probably one of the most risk averse
professions. I would agree. I am one, and I would agree with you.
Why is that? You know the numbers. You
We
should
we know
like
the
all
numbers,
over
but a good finance guy says no 4 out of 5 times.
it.
Is what I always told. I was always taught. A good finance guy says no 4 out of 5 times. A good marketing guy says yes 4 out of 5 times. Uh,
That's right. Yeah.
and
Yeah.
it's just you need them both. You need
Yeah.
them both.
Well, I used to be an actuary, and then I was just like, I spent a lot of time with accountants and stuff like that. But yeah, I was more like, I was not risk averse. I was always I've always felt like I'm calculating the risk, and I was just like, this makes sense. Like I know the numbers, and I never understood why some other people that had the same numbers were like still very risk averse. If you really believe the numbers, go for it.
Well, and there's the key. So I talked about my first investment of my hand shaking when I was writing the check, and I invested with this guy, and long stories.
Yeah.
And now if that guy sends me a deal today, 9 years later, and if I've got free cash, I'm just going to invest. I won't even look at the asset
Yeah.
because I
Yeah.
know, like, and trust the guy. He's done a great job, et cetera, et cetera. First couple of times though, I flew or I drove to the asset. I looked at it. I drove the comps. I asked, cold called some of the comps in the neighborhood and stuff of the asset we were looking at. So,
Yeah.
and so but to your point, to my thinking, what you said is you have de-risked the investment by your education of the
Yeah.
numbers.
Yeah.
And every passive investor, when they start out, I mean, I call it, it's either educating yourself and de-risking it, or otherwise you're just throwing money at something
Yeah.
and speculating.
Yeah.
And
Exactly.
I speculate in the mutual fund market all the time, every month with my 401k, right? Money just goes in there because I pick a bond or a blue chip or whatever. But to me, I now study and I know multifamily very well, and so I can quickly analyze a deal and say if I like it or I don't like it, why not, why, and move on.
Yeah.
And that's all part of your I mean, Buffett says all the time, right? This is paraphrased, but he said, diversification is for losers. That's not exactly what he says, but he goes all in when he understands something.
Yeah. He always invests in things that's the first thing he does. Is he invests only in things that he understands. So if he doesn't understand the business, doesn't get involved. There's no,
right. For the longest time, he never got any tech stocks because until he spent 15 years with Bill Gates and playing chess and backgammon. Anyhow, I don't know, but to your point, that's how you de-risk part of your investment. Nothing's a sure thing.
Yeah. And that's the great thing about real estate is that, it's pretty simple to understand. I mean, you have a building and you rent space to people that have good job, they pay rent, you pay everything else, and then you have some money left over. It's as simple as that. There's no, so that's why it's great.
And it's forced appreciation, right? If I can get my head around that.
That's right.
If I can raise that NOI, it doesn't matter what the guy next door is doing. As long as I can raise my net operating income, the value of that property increases.
Exactly. So I think it makes a lot of sense, I think. And that's why, this is one of the reasons, even if it was more complicated, but this is one of the reasons. It's a simple investment to understand. And, and then you can, you have the appreciation, you have some tax advantages. You can complicate the heck out of it if you want, but at the foundation is very, very simple.
And so it's just finding a neighborhood you like, a property you like, and a sponsor you like. If you're a passive investor, who do you trust that they're going to go out to the property and look at it and touch it and feel it and meet with the property management company, and that they've done their due diligence. I don't need to do it all as a passive investor, but I want to challenge them to convince me that they've done it.
Yeah, and it's exactly.
And
someone that has a track record also, and they've done it before. So
nothing wrong with a first timer, but the higher risk. Back to that.
The other thing for me too that I found that was interesting is that, and that's why the single family rental, I think it's a pretty good space. You don't have to stay there for very long if you don't want to, but getting your feet, it helps you get your feet wet, as opposed, because then you're really doing the investment yourself. You're buying the house, you're going through the process, and you buy 1, 2, 3. You can build a small portfolio and then kind of roll up. But the first one you write the check, even when I wrote my first check for that single family rental in Memphis, I mean, just like I was hoping, so, oh, I hope I don't lose that that EMD, and it was like $500 EMD. But I was still like, oh well, when I wrote that check, $500 check, I was like, well, I hope I make sure that there's enough contingency in there so I can get my EMD back. And it was, and I would,
That's
you know,
funny.
it was nothing. Like it was, but I was still nervous about that. And I think that's part of it is this emotional response that, you know, you don't want to, whenever you're sending money away, you don't want it to go out there and just die and disappear. You want to
And now you're writing EMD checks with a few more zeros behind them.
Yeah, exactly. So now it's, you know, then we bought some apartment buildings also and all of that. And yeah, we wrote some much bigger checks than that. And yeah, and we got our money back. Even like I had a multi-use project in San Francisco Bay Area. And yeah, there was some big checks that were written there just for the EMD piece of it. And we had to back out at one point, and I got my EMD back. But you know,
that's a positive story.
Yeah. So that's the thing. I mean, you have to make sure that you have the right contingency in place, that you are able to, that you follow what you said in the contract by the dates you said you would get things done. And
before you ever got to that point, I don't know the deal, but I'm assuming you had a team, you had partners or professionals, legal counsel,
architect, legal counsel. I also had someone that had a track record of pulling these kinds of deals together. I partnered with him, and and the architect also to help with the zoning and really understand the whole thing, and then a finance guy. And this is the reason why it fell through, is that the financing wanted to wait until we had a ready to issue permit before funding. But that cost that would have cost me like $2 million to get there. So, I didn't have $2 million at the time, so I said, okay, pass.
Come again later.
Yeah, exactly.
Move on, find another deal.
Yeah. He was kind of dragging us along and saying, okay, yeah, I'm in, and then it was okay. And then later on, he kept pushing the date at which he would fund. Eventually, he said, oh yeah, I'll be able to give you the full funding once you have a ready to issue permit. But it's like, there's a lot of
ways away.
Yeah, ways away. But it was in San Francisco, so it was like we were thinking at least 2 years away to get a ready to issue permit. And then there's all kinds of things that happen. Yeah. Nothing is easy in San Francisco.
No, nothing's easy, and there are learning lessons like that everywhere along the journey, right? I mean, not everybody hits home runs every investment, but you're just trying to make sure you fall forward, as I say, and make sure you're doing the right things and surrounding yourself with good people and finding more new good people along the way for everybody. Because I mean, I'm still learning. I'm still learning a lot every day about different intricacies of the business, and that's why I've really settled in on partners and joint venturing with people and stuff that
so Randy, if someone wants to do the same kind of thing that they're doing, like they're looking at you, they're seeing you as an inspiration really to get started, to be a GP, to do multifamily or some form of real estate rental kind of passive income portfolio, how should they get started? What's the first thing they should look at before they kind of like dip their toes in?
The big thing for me would be to education. So, and I think the way to, at least for me, to fast track your growth is to join one of the big national groups. They're going to educate you fast, whether it's Jake and Gino or Sumrock in Dallas or Lifestyles or Mark Kenny, Michael Blanc. I mean, there's a ton of them, no matter what part of the region of the country you're in, because they focus, all those focus on multifamily, except I know Lifestyles also does single family. Yeah, I would say, so you also got to decide kind of what asset class you want to be in, single family or multifamily.
Yeah.
I'm going to encourage you. Everybody wants to start out and do a, 1 or 2 triplex or a 3plex. There's as much work in a 20 unit building as there is a 200 unit building. So partner with somebody, and maybe I've just gain the comfort, but do go bigger faster, just because there's economies of scale and you're going to leverage up quicker. So I would say join one of those one of those national multi-family educational groups would be the first thing, and continue to educate yourself, and then find somebody that you like, that you know, go to one of their conferences. I was working full time. I'd go to a couple weekend conferences a year and find a deal, and pull the trigger and invest passively with somebody. And if that's what you want to do, then just go for the return. Or if you want to take an approach like I did, want to learn something more, ask.
Yeah.
And you'll find most people will allow you to, as long as you're not a pest every week or every hour. But yeah, so, and you just got to decide how much you want. Like, again, I had a kind of a 10-year plan. Maybe you have a 18-month plan, or maybe you just got laid off from your day job and you want to go at this full time and cut the cord altogether. Then
yeah, well, I think that's what's going to happen with this recession. Once we head into it, and then people are going to start losing their jobs. They're going to start looking for what's the next thing here. And I think
that's the wrong time to jump in, because I'd say jump in now, because and start doing it now. And back to my illustration of private equity, I knew I wasn't going to have a job.
Yeah,
it's just a matter of whether it was year 4 or year 5, and so I tried to strategically plan for that, and started educating myself. So
that's right. I mean, the writing is on the wall right now. So even if you have a solid job right now, you should really think about, okay, what's the plan here? If I lose my job, what am I going to do?
Yeah.
Should I invest in education so that I can do real estate investing? Should I invest in,
and so to all my finance friends out there that are like me, that have a hard time ponying up money for those educational groups, I say, I'm a coach today in Rod Khleif's organization, and talk to people all the time that, kind of push back in the money. I say, how many tens or hundreds of thousands of dollars have we invested in our undergraduate, our graduate, or our vocational degrees, and we didn't think anything of it to find a job? So invest a couple $100, go to a seminar, or maybe even a couple $1,000. It's worth it in your fulfillment as an individual, and taking that next journey. Because I argue that, as I know you're one of them, that most people don't want to be employed by somebody unless they're the CEO when they're 60 or 65. And so find that alternative income stream for you.
Yeah.
And like you said, the roadmap is clear. It's been done hundreds of times by those in front of us.
Yeah. Yeah, exactly. Yeah. And for me, like I did look at some of these educational programs. I think we joined one like a long time ago, like 10 years ago and stuff. And it was okay. My preference is, and this is what I do now, is just like one-on-one coaching. So I really cut down the noise on that I see right now with other educational programs, where they teach you about 100 different strategies for making money in real estate. I'd really spend more time understanding what the person's goal is, what they want to do, what are their constraints, and I build a customized roadmap for them and then we stay focused on that, and I help them through.
Well, that's the best. That's the best plan. I mean, of what I just said, if you're offering that I was unaware of that. That's fantastic. I've thought about starting a kind of a boutique educational shop like that myself, where it's, because I would be better at 1-on-3 or 1-on-2 versus 1-on-500.
Yeah.
It's just, it can, and those guys are making a ton of money off of their educational groups, and that's okay.
Well, I think it's kind of like, if you have no idea what you want and stuff like that, I think it's good to kind of like, it broadens your horizon. You see, oh my God, I can't believe everything that's out there. And so if that's what you want, I think this is great. I mean, you learn all kinds of strategies, and it blew my mind sometimes on things they were doing. And you kind of like, can you do this? Even wholesaling was the first one. I said, what? You can do wholesaling? You can just pass on reassign the contract to somebody else? It was like, what? So all kinds of things that kind of blew my mind when I got started, that you could do something like that.
Well, there's so many ways, as you know.
Exactly. So that's the nice thing about it, about the programs that you're mentioning, like the McElroy and all that kind of stuff, is, it broadens your horizon. I think for me, like I've done that, and now I think what people, you want to make sure that you focus. If your time is short and you want to get things done in a relatively short, relatively quickly, I think the coaching and mentorship, going directly for that, I think that's probably the best way to accelerate your path forward. So that's,
I would echo that exactly.
mhm.
It's just a matter of picking a good coach, somebody that you like and get along with and trust. And
Yeah. Yeah, exactly. And I think so, Randy, so since you're a GP of, and then you might have some of the LPs and people that invest in your projects. They're going to want to do like you did before. And they're going to want to say, hey, Randy, is that okay if I ask you a couple of questions, if you teach me a little bit more about your project and how you did it and blah, blah, blah?
And the short answer is yes.
Exactly.
I've had a couple calls already today on that very subject.
Yeah.
I find that there have been many people, Eric, that have built into my real estate education along the way. And so I truly hope that I can give something back. Maybe they'll invest with me someday. Maybe they'll bring me a deal and want me to partner with them.
Yeah.
But that's way down the road. I give a lot away. And I do that intentionally just because I've been blessed and I want to help others in their journey.
Well, obviously, because you're spending some time with me today, talking about your project, your journey through real estate, and so to kind of help other people, inspire them to follow in your path. And on that note, Randy, so what's the best way for people to reach out to you if they're interested in your projects, they want to learn more about what you're doing, and so what's the best way to reach out?
There's, the easiest way is social media. I'm on both LinkedIn and Facebook, and the spelling of my last name is there if you're watching this on YouTube, and it'll also be in the show notes, I'm sure.
Yeah.
The other way is I have a webpage, InvestArk, ARK, invest-ark.com. There's a contact us page on there. I'd love to chat with any of your listening audience about anything real estate. So.
Excellent. Well, thank you very much. I really appreciate your time here. And then you're not on TikTok or Instagram?
Not yet, anyhow. I'm not on TikTok or Instagram. I'm sorry, I just can't be in them all.
No, oh my God, it's just incredible. You should try it out one day. It's an interesting way to reach out to people.
Well, it's amazing, right? I mean, I fought it for a long time. Didn't really join the social media bandwagon, but I've been reformed. So
you have to.
You have to this day and age.
So Randy, thank you very much. Thank you for your time again. So make sure you like and subscribe, and see you next week.
Thanks, Eric. Pleasure.
Thank you for listening to Break Away from the Rat Race with your host, Eric Martel. If you want to share your story and experience with our listeners, please message us on Facebook at Break Away from the Rat Race. Also, please subscribe to our YouTube channel and our podcast on iTunes.